pray for us and let's. One person should pray for us and let's begin. One person should pray for us immediately and let's begin.
Let's pray. Dear Lord, we thank you for the gift of life. Thank you for counting us among the living this morning. Even as we gather this morning to deliberate on issues, help us and guide our learning. We pray for your direction this morning. And we pray that whatever we learn this morning shall be useful to us. In Jesus' name we pray thanksgiving. Amen.
Amen.
Okay, so let me quickly share my screen. Yeah, so yesterday we're dealing with the May 2017, and then I think we got to working hour 10. Is that right?
Yes.
So should I run through again?
Yes.
Yes, sir.
Okay, so I'm running through the May 2017 again. The solution is here. So I'm running through, and those of you who would like to take screenshots when you are done. So yeah, so we started by putting down the title of the question. The question says, it says the following draft consolidated financial statements relates to Bahakomi Group. And then the requirement of the question says we should prepare a consolidated statement of cash flow for the Bahakomi Group for the year ended 31st July in accordance with the requirements of IAS and statements of cash flow. Then we say we should use the indirect method. Okay, so we started as usual. Cash flow from operating activities, the first page. What did I tell you to do? You start from profit before tax, and then you adjust it back to profit before interest and tax. So profit before tax, from profit before tax to profit before interest and tax, the issues you meet on the way are investment income, finance costs, profit on disposal, profit from associates. Is that clear?
Yes, sir.
So you list them. You list
Yes.
your finance cost, investment income, finance cost, profit on disposal, profit from associates. Then now you take care of the non-cash items, depreciation, amortization, impairment, fair value gain or loss. Then that will give you operating cash flow before working capital changes. So that will give you operating cash flow before working capital changes. Then you come to, so this is operating cash flow. Operating cash flow before working capital changes. Then now you go to the working capital changes. So the working capital changes, yes, inventory, receivables, payables. Then you account for interest paid and tax paid. Then for the investing activities and the financing activities, I told you as and when you are working, they will come out by themselves, right?
Yes, sir.
Then the last three lines, you go and prepare your net cash flow, opening balance and closing balance. Then we start our workings. So the first working should be an analysis of cash and cash equivalents. And so you check your current assets here. Cash and cash equivalents, there are 4 items. You will see cash at hand, cash at bank, any short-term investment that has been recognized under current assets, overdraft, and then overdraft. So clearly you can see that under current assets, we have cash and bank. They put the cash and bank together. Opening balance is 3,640. Closing balance is 9,030. Can you all see?
Yes, sir.
Can you all see?
Yes, sir, we can see.
Please, you are many. When I ask questions, respond. If I ask questions and you are not responding, a time will come. I will not be asking questions again. I'll just be solving. When you also ask a question, I don't mind. It's in this. Once you are learning, the lecturer asks a question, you need to respond. Then I'll know your level of understanding. Make the work easier for ourselves. Okay, so you put that down. When we look in the current liabilities, once we see that they've given you the figures in bulk here, it means the breakdown will be in the footnotes. So we check the breakdown in the footnotes, and I will see that there is nothing like overdraft. So this is the analysis of cash and cash equivalents. Then you go and recognize it. So recognizing it there, our closing balance from here, our closing balance is what? 9030. So I can put 9030 here as my closing balance. And then my opening balance is 3640. I can put it here 3640. Then now the net cash flow will be the difference. You work back. So 9030 minus 3640 will give you 5390. So you put that there as 5390 opening balance. So you get these first three ticks. Then now look at the items on the statements of financial position one after the other. The first one is intangible assets. So you open a working for intangible assets. Opening balance is 0, closing balance is 200. So intangible assets, once you have opening balance 0 and then closing balance 200. And in fact, you look through the footnote, whether there has been any changes. If you look through the footnote 1 talks about how the acquisition was. Footnote 2 talks about the net assets of Nyamima. Note 3 is the consideration we paid. Note 4, taxation. Note 5, PPE. Note 6, included in additions to plant and also PPE. Note 7, non-current liabilities include the following. That is it. So there was nothing on intangible asset. It means that the intangible asset, no addition. So the difference will be an increase. Now, if intangible asset increased during the year, in consolidation, the obvious intangible assets that comes in during the year is what? Goodwill. Are you getting it?
Yes.
Goodwill. So it's clear that this is goodwill. And so to confirm it, you come and calculate the goodwill at acquisition. Now, goodwill at acquisition, cost of investment from here. Look at number 3. They said the consideration for the purchase of the shares of Nyamima comprised 44,000 ordinary shares of 1 CD of Bakomi at a value of 550,000. So the cost of investment, there is a share exchange for 550. Are you following?
Yes,
Yes,
sir.
sir.
And then a balance of 28,000 in cash. So cash 28,000, giving us 578. Now NCI at acquisition, if you look at the net assets of the subsidiary from here, the following were recorded at fair values of Nyamima at the date of acquisition. The whole net assets was what? 504. Can you see?
Yes.
And if it's 504, the question says we own Nyamima 75%. We own Nyamima 75% from here. Therefore, if we own him 75%, NCI will be 25%. Is that clear?
Yes, sir.
So 25% of the 504. When you add it up, you have 704 as your 100% consideration. Then you take out the net assets of 504 from it. You see that clearly to prove that the goodwill is 200. Can you see?
Yes, sir.
Then we go to, yes, the PPE. The next item there is tangible assets. So we go to PPE. Now, when we go to PPE, the question told us in the footnote that there was a disposal of PPE. Look at the PPE. They said included in additions to plant and machinery are items totaling 1,700 acquired under finance lease. The plant and machinery disposal resulted in a profit of 300. So if we treat the disposal, now how do we treat disposals in reporting? We compare the carrying amount of the disposed assets to the sale proceeds. Is that right?
Yes, sir.
So the carrying amount of the disposed assets, they've given us our PPE schedule here to make it easy for us. If you look at the cost, the disposals, you can see clearly that cost of the disposed asset is 1,000 cedis. So take the cost of 1,000 cedis and then check under the depreciation. You see disposal here, disposal. So the disposal, depreciation on the disposed asset is what? 200. So we take the 200 out to get the carrying amount of the disposed asset. Now we are supposed to compare the carrying amount to the sale proceeds to see the profit. But they've told you the profit directly. They didn't tell you the sale proceeds. They've told you the plant and machinery disposal resulted in a profit of what? 300,000. So it means that if you add the profit to the carrying amount, you must get the cash proceeds. Is that clear?
Yes.
Good.
Okay.
Then the question also said, that included in additions to plant and machinery are items totaling 17. So it means that addition of 1,700,000 was made during the year. So the addition of 1,700,000, we need to investigate which one came by cash. So look at the note 5, addition to PPE. Clearly, we can see that the question told us that the total addition, look here, if you look in the cost, addition to PPE was 4,200. Can you see?
Yes, sir.
So the total addition was 4,200. They are saying that out of this 4,200, 1.7 came through finance lease. Please, whose background is that? If your background is noisy, then kindly, Abdurrafik, your background is disturbing us, then you kindly go off. If you can't be quiet, then go off. Yes, they said out of this 4,200, 1,700 was acquired through finance lease. So if we take the finance lease out 1,700, then when we acquire the subsidiary, you can see clearly here. Look at it, acquisition of subsidiary. When they acquired the subsidiary, in the footnote, they said what? The following recorded at fair value refers to Namima Limited at the date of acquisition. So when we acquired the subsidiary, it also came with PPE. That is it. Can you see 300? The subsidiary also came with PPE 300. Can you see the 300? The
Yes,
330.
sir. Yes, 300.
330. So when we take the subsidiaries own out 330, then the rest was the one we acquired by cash. Are you getting the point?
Yes.
Yes.
So the difference of 210 is what we bought by cash. Then from the statement of financial position, the next thing is what? Investment in associate. So we tackle investment in associate. Opening balance is 2,000. Closing balance is 2,200. We put it there. Now, in the P&L, the associate made profit. So you come here and look at it. Income from interest in associate holdings. You can see it's 990. Can you see?
Yes, sir.
So we add the 990 to it. Then in the footnote, you were told that the associate paid tax. Look at footnote number 4. The taxation charge in the consolidated statement of profit or loss is made up of, you see, tax attributed to associate undertakings 355. So the associate paid tax of 355. It will reduce its investment. Therefore, the total investment on associate is 2,635. But at the end of the year, it has become 2,200. It means we have received some dividend from the associate. That's dividend received from associate 435. Can you see?
Yes, sir.
Then we continue. Next item on the statement of financial position, other investments did not change, ignore it. Current asset, inventory, receivables, we use this to do our working capital changes. So you can see clearly,
Hello.
yes, working capital changes. Inventory,
What
receivables,
with
please.
respect to the PPE,
Yes. Yes.
the
Ask your
the
question.
435. With respect to the PPE,
Yes.
the 435, is it supposed to be a negative figure?
435 in the PPE.
Yes,
Where is the
yes.
435?
The dividend received, balance,
In the associate?
dividend working 6.
Yeah,
And that's the investment.
Oh,
investment.
oh, okay,
It
the
should be.
effect. Okay, that's fine. The effect. Thank you. So,
Hello, sir.
yes.
Sorry, with the investments in associates,
Mhm.
you said the closing balance is
Yes.
2,200, and
Yes.
so the difference will be dividend received.
Yes.
Okay. I was just coming to ask, won't it rather? So is it dividend received or dividend
Dividend
paid?
paid.
No, the group, see, this is consolidation. We
Okay.
invested in associate. So the associate rather gives us dividends. Are you getting it?
Okay.
Okay.
So it's a dividend receipt. But remember that the group shares profit and pays dividend to the parent and associate. So you will have dividend paid to parent, dividend paid to associate, but dividend paid to NCI. But the associate, you have a dividend received. Are you getting it?
Yes.
So take note, every day in a consolidated cash flow, you have dividend paid to parent, dividend paid to what do you call NCI, but you have a dividend received rather from associates. Are you getting it?
Okay.
Yes. Now, working capital changes. Yes, if you list them, inventory, receivables, and payables. Inventories, the opening balance is 2,000, receivables is 2,550. Payables, we don't know, so we just leave payables yet. Then acquisition of subsidiary. The closing balance, inventory closing balance is 3,930. Opening balance is 3,700. Now let's go and look for the balances of the payables and the current assets, current liabilities. So when you get to the current liabilities, here, the breakdown of the current liabilities is here. You can see they've given us trade payables. Opening balance of trade payables is what? 960. And then closing balance is 1,600. Can you see?
Yes.
Okay. Abdul Kudus, ask your question.
Back to the investment in associate again.
Yes.
Working 6.
Yes.
I'm confused. I'm confused as to dividend received being a negative figure.
No. As for the, you see, clearly you were not here when we started cash flow, right? Right?
I wasn't sure. Yes.
So you see, this is it. That is why, you see, ICA students, we always tell you, that is why you must never miss class, because if you miss one class, something small the lecturer explained, now you didn't get, it can confuse you for 3 months and you will get frustrated and frustrated and frustrated. That small thing could beat you some 1 mark. That is why it's very, very important. I have told you that in the workings, we are looking for the changes in figures. So some may be positive, some may be negative. But when you are recording on the statement, then you record the actual effect. Are you getting the point?
Yes.
Here we are only doing workings to see the difference in the figures. So as a matter of workings, here the difference in the figure was what? 435. What it means is that the investment in associate has reduced by 435. And if your investment in associate reduces, it means you've received dividend from the associate. Are you getting it?
Yes.
It's like you have a bank account. You have a bank account which is 2,635. Tomorrow it has reduced to 2,200. It means you've withdrawn 435. So the 435 will reduce the balance at the bank. But for you, it will come into your hands as a positive value. Are you getting it?
All right. Sorry. I understand.
Good. So in the workings, we are looking for the changes in figures. So some may be positive, some may be negative. But when you are recognizing it on the statement, then you look at the effect, whether it was an inflow or an outflow. Are you getting the point?
Okay.
Yes, sir.
Good. So the payables opening balance, you can see it here. Trade payables, you can see trade payables opening balance is 960, closing balance is what? 1,600. Then when we acquire the subsidiary, if you go up there, you will see that under acquisition of subsidiary, inventories, it brought 64. Can you see? Receivables, it brought 56. Current liabilities, that should be the payables. Now, the payables is supposed to be 170, but they said it includes a tax of what? 34. You know, tax is a different item. So we take the tax of 34 out. So here, this 136, this is how we got it. That's it. 170 minus 34. Can you see?
Yes,
Can you
sir.
see from here?
Yes.
170 minus 34 tax, giving 136. That is it. So when you sum them up, you get a total of these totals. When we get to the statement, we'll go and do the working capital changes. Then from there, you go to 8. Cash and bank has been recorded already. Now the next item is the current liabilities. So let's go to the current liabilities and work the breakdown. Yes, these are the current liabilities. The first one is trade payables. We have dealt with it under working capital changes. The next one is obligation under finance lease. So you open working for finance lease. Then bear in mind, I have told you that there are some 3 items. Anytime you are working on them, look at both non-current liability and current liability. What are those 3 items? Government grants, finance lease, and income tax. Is that clear?
Yes, sir.
Yes.
Anytime you are adding the liabilities, you add both the non-current liability and then the current liability. So look at obligation and the finance lease. Now the opening balance, you can see there is 400 here. This is the 400. Closing balance too, you can see there is 480. This is the 480. This is the current liability part. The non-current liability part is up there. When you go to non-current liabilities, note 6, you can see obligation and the finance lease. Opening balance is 1340. So I add it to the opening balance. Can you see it here? And then closing balance is 1417. I've also added it to the closing balance. So you add non-current and current for opening balance, get 1740. Non-current and current for closing balance, get 1897. Then the finance lease. You remember in PPE, note 6, they told you included in additions to plant and machinery is what? 17 acquired under finance lease. That means there was an addition of 1,700. When you add it, the total is 3440. But at the end of the year, it has reduced to 1897. It means we've paid some of the finance lease out, 1543. Are you getting the point?
Yes, sir.
All right. Then from there, we've done finance. We go to corporation tax, that is income tax. Income tax, yes, the same thing. Income tax, opening balance here is 434, that is it. Closing balance is 924, that is it. This is the current part. And so let's go to the non-current part. You see the non-current liabilities, it didn't appear here. But on the statement, look at the statement. They provided the non-current liability tax here, deferred tax. Can you see?
Yes, sir. Provision
So
for
opening balance is 26. I've added it to the opening balance. Closing balance is 60. I've added it to the closing balance. Now let's consider the tax for the year. The tax for the year. In the P&L, how much tax did the parent pay? Let's say profit after before tax, taxation. Yes, what is the taxation? Total taxation 1345 for the whole group. But then they give us the breakdown of the tax to see how much the parent paid, how much associate paid, and all that. So let's go down and see breakdown of the taxation. They gave it somewhere.
Not four.
Okay. Taxation charge in the consolidated statement of profit or loss. They say this is the total tax charge. Corporation tax is 782. So for the year is 782 plus 208. Now, tax related to that associate has been dealt with in the associate. Is that clear?
yeah.
So we have 782 plus 208. But there was an extra tax here. Remember, in the current liabilities, here, in the current liabilities, you remember when we the net assets of the subsidiary here, in the net assets of the subsidiary, when we took the payables, there was a tax of 34 there. Can you see?
Yes.
That means we're left with, the subsidiary was left with a payable tax of 34. So it will also increase the total tax added to 34, added to the tax for the year. Are you getting the point?
Yeah.
When you sum all, the total becomes 1484. Now, when you compare it to the closing balance of 984, it means a tax of 500 has been paid, right?
Yes, sir.
Yeah.
Okay, so we have tackled tax. After tackling tax, yes, what is there? We've tackled tax. Now, accrued interest, that's interest payable. So we can continue from here. The tax was working number what?
9.
Number 9. So let's go to working number 10. Let's go to working number 10. Yeah, so working number 10. Accrued interest. So interest payable. Interest payable. What is the opening balance of the interest? Opening balance was 60. What about closing balance? Closing balance is what? 80. Can you see?
Yes.
Good. Now let's look at the tax, the interest in the P&L. So for the year, let's go to the P&L. Yes. What is the interest in the P&L? What is the interest in the P&L? You can see
300.
300.
300.
300.
Oh. So, a moment. Okay, so 300. Yes. So should we add to it? What's the total?
360.
The total is 360. When we compare to the closing balance, so the interest paid will be what?
280.
Interest paid is 280. Okay. Now, what we need to know is that there was footnote on the interest here. Watch this. This is the last trick under this question. This is very cash flow, very technical, but I want to break it down for you because if you should have a cash flow, I'm expecting something like this. After solving May 2015 and May 2017 with you, you shouldn't have any problem with cash flow. Look at this. under non-current liabilities, the debentures that were paid, they said there had been an issue of debentures on 1st August 2015. The par value was 3 million, but they were issued at a discount of 100, making it 2.9, and the effective interest rate was 7%. Now, IFRS 9 tells us that debentures should be measured at what? Amortized cost, right?
Mhm.
Good. So what it means is that we will do this. We will do a working level for the interest. So let me do 11 working 11 for the debenture. So the debenture, yes, the opening balance, they said it was issued at what? 3 million, but then a discount of what was given? 1,000, right?
Yes.
Yes, sir.
100. Sorry, 100.
100.
Opening balance, yes, we have 3,000 minus 100, giving you 2,900. Then we add the effective interest. Do you remember? Do you remember that? Or I should, maybe this is what you know, the horizontal one. Let me do the horizontal one for you so that nobody will chew me. I think most of you have been doing the horizontal form, not the vertical form. Let me do that. You'll see that it is the same thing. So you will see why learning is important. You need to understand the thing in real life. This is what you do. I think most of you in class, you do this, the debenture. You take the year. More of you are familiar with this. You take the year, then the opening balance. Is that not so? Then plus the effective interest. Is that not so?
Yeah, should balance.
Effective interest at what? 7%. Is that not so?
Yeah.
Then minus the nominal cash paid. Then you get a closing balance. I think this is what you learned, right?
Yeah.
So just for the first year, the opening balance is 3,000 minus 3,000 minus 100 gives you what? That's 2,900, eh? 7% effective interest. Calculate 7% of that for me. 3,900 times 7%. I'm getting 2,900 times 7%. I'm getting 203. Am I right?
Yes, 203.
So interest of 203. Then they say what? Yes, cash paid. How much cash was paid on the debenture? They said the debenture was what? 6%. Can you see the debenture was 6%?
Yes,
The nominal
6%.
interest was 6%. So 6% on the, the nominal interest is on the par value, right? So 6% of the 3,000. 3,000 times 6% will give you what? 180. So 180, right? So if the cash paid is 180, then the closing balance is 2,900 plus 203 minus 180, giving you 2,923. Is that right? So
Yes, sir.
this is how come the debenture became 2,923, which you are seeing here, 2,923. Can you see?
Yeah.
Good.
Yes.
But then this debenture, you can see it has brought you extra finance cost. This is the extra finance cost. This is the extra finance cost, which is interest. The extra finance cost, which is interest, that's the difference between the effective interest and the nominal interest. That's the 203 effective interest minus the nominal interest of what? 180. That will give you what? 23, right? Meaning that extra interest of 23 was recognized as a result of the amortized cost. So what it means is that here, what it means is that in the interest you calculated here, the interest payable, did you see that the total interest balance for the year was what? 280. But out of that 280, 23 came as a result of what? The debenture that is held for trading difference between amortized cost and effective interest. So that means that the actual physical cash paid is the 280 minus the 23. Do you understand?
Mm-hmm.
Do we understand?
Yes.
The difference in interest for the year is 280, but the 280, not all of them was cash. 23 came as a result of the debenture. That is as a result of difference between effective interest and nominal interest, meaning that this 23 is part of the 280. But in the cash flow statement, we are looking for only the cash portion. It means that the cash portion will be 280 minus 23. Are you getting it?
Okay.
Just like the PPE.
Mm-hmm.
So let me go up there and then record that. So the cash portion of interest paid. So let me say the cash portion of interest paid will be the 280, the 280 in working number 10 minus the 23, which will give you what? 250 watts, 7, right? Right?
Yes, sir. Yes, sir.
Good. So let's finish it. Then you take all the pictures at once and get a
So
complete
please,
solution.
the balance carry forward, is it not 2995?
2,900 plus 203 minus 180.
Yeah, it's supposed to be 2995.
Oh, how? How? Are you adding 2,900 plus 203 minus 180? You do 2,923. What are you doing? 2,900 plus 203 minus 180.
2923.
Check your calculators. Okay, so we have done that.
And it's
Yes.
3103 minus 180.
What is
It's
3,103?
2900 plus 203
Please, where are you
minus
getting the
180.
303 from? The figure here is 2,900. So where are you getting the 303
Yeah,
from?
I've seen it. Sorry,
Okay.
I made it 10. So.
Okay. So that is it. Let's go back to the statement of financial position to find out what is left. So we have tackled the current liabilities, we've tackled the non-current liabilities, we've tackled the deferred tax. Now equity, share capital. So share capital, let's go and deal with share capital. Yes. So that's working number 12, eh?
Yes.
Well, let's deal with the share capital. So share issue. There's a capital surplus. Okay. So let's tackle both of them. Share capital surplus. Then you create the total to see the total effect. So what is the opening balance? Give me the opening balance for both of them. Share capital is what? 4,000.
4,000.
Capital surplus is what?
4190.
4,190. Please add them for me. 8,190.
8190.
Now, when we acquired the subsidiary, there was a share exchange, right?
Yeah.
Yes, sir.
Remember when we acquired the subsidiary, there was a share exchange. Let's go there in the acquisition of the starting working 2. Let me quickly go and search for working 2 so that you see. Let's take our time and work it nicely and get the understanding. That is better. You see, when we acquired the subsidiary working 3, there was a share exchange of 550. Can you see it here?
Yeah.
So that share exchange, you know, it will definitely increase share capital, right?
Mm-hmm.
So let's go and add the 550 to share capital. So acquisition of a subsidiary working 3, it brought in 550. So let's add the 550 to it. So when we add the 550 to it, yes, what is the total? What is the total?
8740.
8740.
40.
Now, when you compare to the closing balance, there's closing balance, share capital, and then capital surplus. What is it? Share capital is 7 what? 880, eh?
7880.
7880. And then capital surplus is for 5766.
5766.
Please add them for me. Give me 13,646, right? Right?
Yes, sir.
So the difference is what? There's cash proceeds from issue. So there was further issue. Calculate it for me. That's 4906, right? Right? 4906. Am I right?
Sir, please wait.
Oh, the difference between 8740 and 13646.
Sir, is correct, is correct.
Let's be tactical. Okay.
Mm.
Then we have what? Retained earnings and NCI. So retained earnings, that will give us dividend paid to the parent. So, yeah, so those of you who are wondering about the dividend, now watch this. In working 13, the retained earnings, that will give us the dividend paid to the parent. So, yes, retained earnings. What's the opening balance of retained earnings?
4600.
Opening balance is 4600. What's the closing balance?
6270.
6270.
6270. Okay. Now, in the P&L, how much profit was attributable to the parent? P&L attributable to parents. So attributable to parents. Profit attributable to parent. Let's see. In the P&L, yes, profit attributable to the parent was what? 2470, right?
470, yes, sir.
Yes, sir.
2470. When you add it, the total gives you what?
7070.
7070. So if it has reduced to 6270, it means we pay dividend to the parent of how much?
800.
800.
Yeah,
So that's
800.
dividend paid to the parents. Are you okay?
Yes.
Please, do we understand?
Yes, please.
Yes.
Okay. Then you do the same for NCI. Then you do the same for NCI. So let's go to NCI. Now we're working about what? 14, eh?
Mm.
So NCI working 14. Oh. NCI. What's the opening balance for NCI? Yes, NCI, what's the opening balance?
You don't have opening balance.
Zero.
Opening balance is 0. Closing balance is what?
230.
230.
230. So NCI opening balance is 0. Now, NCI, the P&L, profit attributable to NCI. Yes, attributable to NCI. Just as you got profit attributable to parent, to NCI to take profit attributable to NCI. Yes, let's check our P&L. What's the profit attributable to NCI? Yes, 200, right?
200, yes.
200.
200.
So you add the 200 to this. Now, there was also NCI at acquisition, right? Right? So
Yes.
NCI at acquisition. NCI at acquisition of the subsidiary, which we got in working 3. That was 10% of the 25% of the 540. Do you remember? And he gave us 126. Do you remember? Or I should go up there.
Yes, yes, we remember.
Now, for the sake of those who cannot see, oh, my board has started misbehaving. Oh. Please, let me reshare the board again. It's misbehaving. Let me reshare it again. I think you can see now, right?
Yes.
Okay, so the debenture, what working number is it? Let's go and trace it. The debenture. The debenture was what working number?
Workings 11.
So the cash proceeds from it, trace it. Let's see. Working 11, debenture. Yes, so the 2923, right?
Yes.
So 2923 inflow. So let's go to financing activity. So financing activity. Yes. Debenture. So receipt of debenture. That's working number what?
11.
Working 11. 2923 money coming inflow. All right. So that is it. Then let's check through the P&L. You can see there is income from investment. Now, once there is income from investment 80, it means there was an interest received. It's a investment activity. Exactly. Always check this. If interest receivable is not on the statement of financial position, it's assumed that the opening and closing balances are zero. Are you getting it?
Mm-hmm.
So the income from investment is something like this. Let me go down and work it. Let me work it raw for you to see. Anytime there is investment income, and then there is no interest received, investment income is interest received. So if there is no interest received on the statement of financial position, what it means is that the investment income was actually the total interest received. So it looks like this. If you are following the working you are doing, this is how you would have done that. What it means is that in working 15, interest received. Since there is no interest receivable on the statement, it means the opening balance is zero, and then the closing balance is also zero. So something like this. Opening balance is zero, closing balance is also zero. So I can see it also. It's also zero. So the P&L interest received is investment income, that is 80. So the total gives you 80. Can you see? So the total is 80. So the difference will still be the interest received. Please, do you understand?
Yeah.
Which is still 80. So anytime you have investment income and you don't have interest receivable on the statement, it means the investment income is actually the total interest received of 80. Do we understand?
Mm-hmm.
Hello?
Yes,
So
sir.
please take that side again.
Hey, the rest who are not responding, all of them are off. A lot of people have switched off their phone. Abdul Rafiq, Adwa Bwedua, Alexander, Alasan Shaibu, Daniel Busumpra, Da, Mariam Owusu Dakwa, Rhoda, and Co. What's happening? I'm saying that anytime you see investment income and there is no interest received, just like if you see finance cost, you know, when you see finance cost, that's interest paid. So there must be interest payable on the statement. Is that right?
Yes.
The same way, when you see investment income, that's interest received, there must be interest receivable on the statement. Are you getting the point?
Yeah.
So if there is no interest receivable on the statement, it's assumed that the opening and closing balances are zero. Are you getting the point?
Yes.
Yeah.
So opening balance is zero, closing balance is zero. Then you add the interest for the year P&L 80. The total will give you 80. It means that the difference is still 80, meaning that the interest received, the investment income is actually the total interest received. which is an investing activity. So you go to investing activity and recognize it. Interest received of 80. So let's go there. Let's go to investment income, investment activities, and recognize interest received of 80. So interest received investment 14 of 80. Are you okay?
Yes, sir.
Then the acquisition of subsidiary. Acquisition of subsidiary. Remember, when we acquired the subsidiary, we paid cash of what? 28. So that's an outflow of 28. And then later, the subsidiary brought cash. Do you remember? That last working I taught you in November 2015, May 2015, I taught you that that should be your last thing. Once you paid cash for the subsidiary, look at this. We paid cash for the subsidiary. When the subsidiary was coming, the net asset, the subsidiary also brought a cash and bank of 224. Can you see?
Yeah.
So we've paid 28 outflow and we've received 224 inflow. If you check your November 2015 solution, I did a similar thing. This is how I did it. Let me work that for you. If you check your your May 2015 solution, I did this. And that's why it's important I tell you that revise previous work done before you come for the next work. It will improve your understanding drastically. So let me do that to remember you. So let me do that to remember you. This is what I did. In the May 2015 question, 2016, sorry, I did this. I did it as a separate working like this. And I called it working 16. And I said acquisition of subsidiary.
That's it, yeah.
That's the cash proceeds. The cash proceeds. Every day in cash flow, you must remember that last. You see, cash paid for the subsidiary. Now, we paid how much cash to acquire? 28, right?
Yes, sir.
We paid 28 to acquire. We paid 28 outflow to acquire. Then the subsidiary came with cash. Cash received in the net assets. Do you remember? In the net assets, it brought 224. So that will give you what? An inflow of what? That will give you an inflow of what? 224 minus 28. Hey, today the class is dull.
196.
196.
So 196. So that is what you recognize here. I think when you take everything complete and then you sit down, you should understand it, bearing that you have done November 2015. Take it to all and then let's move on. Yes, so that gives us what? 196, right?
Mm-hmm.
196. Okay, so we have finished. We are finished with recognizing our items. Let's check. It's a very long cash flow. Let's check if we balance. Let's check the figures from. Let's check the figures from the. Okay, let's see. Let's see the solution. If we have all figures correct, then we can move on. This is Okay, so question 1. Sometimes the way they put this, but I'm sure once I've solved it already, you understand. Profit before tax, 4015. They subtracted 990. Yeah, so that 990 is the associate. Can you see?
Yeah.
So that's how they do it. They normally subtract from the associate from there. But I don't. So let me tick it that this is the 990. So please be watching. The 990 is there. Then we have what? Depreciation plus 650. It is there. Profit on disposal of asset 300. It is there. Finance cost 80. It is there. Can you see? Investment income 80. It is there. Finance cost 300. It is also there. Can you see?
Yes.
Yes. Working capital changes. You can see inventory 1866 is there. Receivables 1094 is there. Payables 504 is there. Yes. Then interest paid 257 is there. Tax paid of 500 is also there, I think. Okay, so please sum all this for me. Please take your calculator, sum it for me, and let's compare. 4015. Let's all do that. 4015 minus 80 plus 300. Let's all calculate carefully. Minus 300 minus 990 plus 650 is giving 3595 here. That's correct.
Yes.
3595.
3595 here is correct. Minus 1866 minus 1094 plus 504. And then minus 257 and then minus 500. I'm getting 382. Is it correct that their solution? 382 is correct. Can you see?
Mm-hmm.
So 382, just making sure you haven't had any oversight because of the way we solved the question alpha. 382 positive. Let's go to their investing activities and check. Investing activities, positive 196 is there. 80. Oh, the investment income, they've recorded it under financing activity. You see what I talk about? You see the oversight? Interest received, investment, they've recorded it under financing. Can you see?
The
Can you
80,
see?
yes.
We have
Yes.
recorded it under the net effect will be the same by classification. So 80, then we have, you see, payment for tangible asset 2170 is there. Proceeds from disposal 1100 is there. Now the dividend received from associate is also investing. I think they've also put that here. They also put it in financing. Can you see?
Yeah.
It's not a dividend, it's dividend received. Associate, when you buy an associate, it's an investing activity. You invested in the associate. So if you receive dividend from there, it's an investing activity. Exactly.
Yes, sir.
So that's why, so you see, I see a solution. Sometimes when you look at during the typing, sometimes there are oversights. So you need to solve the question yourself and then get your own figures first before you can. That is why most often you call, some of us will call that I want this solution, I didn't understand this. You are not supposed to watch. You are supposed to solve it yourself first. Yes, calculate and let's see. 1001 minus 2170 plus 435 plus 80 plus 196. I'm getting 359 negative. So you let me put that here. 359 negative. -359. Yes, let's look at the financing activities. So the financing activities, proceeds from issue of shares 4906 is there. Proceeds from issue of loan. Oh, the issue of loan. We took the closing balance. Oh, it is the cash we received. This is an oversight. The cash received was 2,900. Do you remember? The loan, it was 3,000 minus a discount of 1,000. Can you see?
Yes.
Hello?
2900.
Yes, sir.
Yeah.
Yes, sir.
2,900. That is what we have, not the. Oh, but how did I do such a fundamental error? It's the cash proceeds we are looking for. So the 2,900, the cash proceeds, the one you received. That's the opening balance and not the closing balance. 2,900, that is there. Then payment for finance lease 1,543 is also there. Now the 435 and the 80 has been recognized up there, so it's correct. Then we have dividend paid to the group 800, that is there. Dividend paid to NCR 96, that is also there. So I'm sure, should we sum this up, it should balance. So sum this up for us, sum the financing for us. Sum the financing for us. Sum it for us. Let me see. Negative 1,543 plus 4,906 minus 800 minus 96 plus 2,900. I'm getting 5,367 positive.
Yes.
5,367.
367.
So this is the net cash flow. Net cash flow. The network is a bit slow. Let's go. Net cash flow from financing activities. Okay, so let's sum the three of them and see if we can get a net. What do you get from operating cash flows? Operations was what? 382. So let's check. Positive 382 minus 359, then plus 5,367. I'm getting 5,390. Is it correct? Is it correct? Correct.
Yes,
That's
sir.
it. It's correct. So this is the actual presentation. So let me go up so that the one who is taking the screenshot give us a complete shot of the whole thing. Let me go up for you. The one taking the screenshot, now we are relying on you, so don't disappoint us. Give us complete shot. Start it for us. Are you taking it?
Yes, sir.
So take this first. So now you are taking it completely with all the workings so that you understand it well. Have you taken this?
Yes, sir.
So let me move up to the working capital changes. So I'll move up to this place. Take this for us. Wait, let me position it well. Take this for us.
I have.
Let me start from investing. Take this for us.
I have.
Then let me go to the nets. Okay, financing and the nets. Take this for us. Have you done so?
Yeah.
Let's take all the workings together again to make sure
So
that you have done.
the ones I've uploaded is fine. I've numbered them, so I'm not sure we have with the.
So it's okay, right?
Yes.
Is everybody okay? Are we all okay so that we can introduce ourselves to business valuation? Are we okay?
Yes,
Yeah.
sir.
Okay, the rest who are not responding, what is the, you know me, I'll mention your names. Me, I don't teach a class that will be quiet and then I will be talking.
They
So I'm
will
going to do,
talk.
you see, when they saw that I'm going to do the roll call, they started unmuting themselves. We have said Uji, Adwa Bwedua. Adwa Bwedua is always muted. Who is the Adwa Bwedua? Our mother. Who is Adwa Bwedua? Let's hear from you. Adwa Bwedua. Who is
Yes,
Adwa
sir.
Bwedua?
Yes, sir,
Are
I'm
you
here.
sleeping?
No, I'm not sleeping. I'm here.
Do you understand what is going on there?
I'm following. Not
Mariam,
fully, I'm
Owusu
well.
Adankwa. Who is Mariam Owusu Adankwa? Mariam. Who is Mariam? Mariam Owusu Adankwa. Okay, Mariam is fast. Rhoda. Rhoda,
I'm
let's hear
here.
from
I'm here, sir.
Rhoda. Let's hear from Rhoda. Okay, so our two thirds are following. That is fine. That is fine. So I believe the solution is good. Is it okay that we can go to business valuation?
Yes,
Yes,
it's
sir.
okay. But please,
Very good.
can I ask a question?
Go ahead, please. Go ahead. Feel free.
It's on the addition to the PPE, I realized the finance list was deducted. Please, is there a reason why?
Good. Let me go back there. Let me go back there. Let me go back there. This is a question I was expecting someone to ask actually. The moment you ask this, then it tells me that you are following. You were not actually sleeping. Sorry. Now, in the question, the footnote, they have already told us how much was added to PPE. Let me go there and confirm it for you. I see the questions. How many? So if you people are joking, sometimes I wonder, look at this plenty question you have to solve. So if you, the student yourself, you are joking, then you are giving them chance. Okay, let's see. Look at the note VI, madam. It says that included in the additions to plant and machinery are items totaling 1,700. Can you see?
Yes, please.
So it means that the total addition for the year is like the total addition for the year is 1,700. They've told you that the whole addition is 1,700. So if you have the whole addition to be 1,700, and then they are, they said 1,700 acquired under finance lease. Sorry. So the finance lease part of the addition is 1,700. Meanwhile, the total addition for the year, look at the PPE schedule here. Look at the cost. Total additions for the year is 4,200. Can you see it here?
Yes, please.
So in all, we added 4,200. We added 4,200 to PPE. But in that 4,200, not all of them is cash. So we are looking for the cash portion. Are you getting the point?
Okay.
And then they are telling you that out of that 4,200, 1,007 is finance lease. So we take the finance lease, we don't pay cash. So we take finance lease, the finance lease aspect of the asset. So we take that one out. Then when we acquire the subsidiary in note 2, look at this. When we acquired the subsidiary, the net assets of the subsidiary, it also came with plant and machinery, 300, 330. Can you see?
Yes, please.
So the subsidiary also brought 330. We didn't pay cash for it. So we also take that out. So the rest we paid cash for. Are you getting it?
Yes, please. Thank you.
The question has already given you the total addition. So you subtract the ones that were not cash.
The non-cash items. Okay.
Exactly.
Okay,
Are we fine?
Thank you. Yes, please. Thank you.
Any other question before we move on?
No, thank you.
So can we begin business valuation?
Yes, sir.
All right. So let me pause the recording and then deal with. Please, can you see the board?
Yes, sir.
Yes, sir.
Now, please, this is a new topic, business valuation. And if you ask me, if I'm the one writing the paper, this diet, even though I will not take chances, I would make sure that my business valuation is 100% intact before I sit for the paper. Because you can see, IC has examined capital reductions, I think 3 times continuously, right?
Continuous.
Is it 3 or 2?
2.
2 times continuously. It will be extremely difficult for them to examine it 3 times. I'm not saying that is what they will do, but if you look at the trend, as a smart student, when you are going to write exams, at least you need to take the past question and look at the trend. If you look at the trend, it tells you clearly that it is very likely you will have a business valuation this diet, because ICA has examined capital reduction 2 times. So even though in that question, I would go ahead and learn my capital reduction, all right, but I'll make sure that business valuation, if I have any shortcoming there, I will address it before I go to the exam so because the chances of you getting a business valuation is 90%. Are you getting the point?
Yes, sir.
So open your eyes. Now, business valuation, I need to introduce for you to understand before we solve the question. Normally, that's my start. I wouldn't want to solve question and then now you'll be asking where from this. No, I need to call your attention to, I think that worked with cash flow because I introduced certain things. You got a fair idea, eh?
Yeah.
So business valuation. Now, when we say business valuation, what comes into your mind? It's simply we are valuing the market price. We are valuing the market price of a company's shares. When we say business valuation, we are valuing the market price of a company's shares. That is what we want to know. What is the market value of the company's shares? And so the first question I'll ask is, why the need for business valuation? Why do we need to value company shares? Somebody should tell me, why do we need to value the market price of a company shares? At what instance will it become necessary for us to do that? Let's
When,
talk, please.
yes,
It
sir.
is the interaction.
I think
Hello, I want to hear everybody's voice. I
When
want
you
to hear.
want to be listed
Hello,
on the stock market.
yes.
When there's going to be a takeover.
good. You see, let me hear everybody's voice. It should be a discussion so that in the exam, so if you can't remember what Enoch said, you can remember what somebody said and remember what somebody said and put it together. So you see why you should. Yes, Mariam, Owusu-Dakwa, let's hear from you.
Yeah,
Mariam,
I said that if you want to be listed on the Ghana stock market,
please, if you want to talk, you raise your hand, then I see you. So watch. I'm not saying anything. The solution you are giving me is what I'm putting down. One, somebody says, when a company wants to what? Get listed on the stock exchange, right?
Yes, sir.
When a company is to be listed on the stock exchange, and the company's share price must be determined. Yes, so when it is necessary that you have to list on the stock exchange, yes, Abdul Rafiq, let's hear from Abdul Rafiq.
Okay. When a company wants to sell part of its shares.
Okay, yes, when a company decides to dispose its shares, because once you are selling the share, we need to know the market value. Are you getting it?
Yes, sir.
Normally, in an arm's length transaction, if you want to sell on a normal transaction, you need to determine the market value of the shares. Yes, who also tell us something?
The
Please, I
purpose
don't
of
know.
taxation.
I said, when you want to talk, raise your hand. And then I don't know anything. It's the answers you are giving me that I'm putting down. In the exam, so I expect you to remember. I didn't tell you this thing. You told me, so bring them out. Yes. 3. Yes, Abdul Kudus.
For the purpose of taxation.
For the purpose of taxing, when exactly? When exactly do we tax shares? When we want to ascertain capital gain,
Yes.
For taxation purposes, in ascertaining what? In ascertaining capital gain on shares. You see, when we want to calculate the capital gain on your shares so that we tax you, we will need to value it. Yes, who also give me another?
Again.
yes, sir. When you want to measure measures and acquisition,
Good.
you want to measure with another company.
Good. When there is a scheme of measure, when there is a scheme of measure and participating companies shares must be valued. Once we are going to merge, everybody's shares must be valued. So it will call for business valuation. Yes, Abdul Kudus. Please, hold on, Abdul Kudus, hold on. We have about 22
Sir,
people
I've raised
online.
up my hands.
Angela, and you have allowed 3 people to be getting the answers. So in the exam, so can you remember it? At least if we get 5 points, 5 points is okay. Imagine you go to the exam so and they give you 5-mark question.
Sir, I've captured this.
Business
Securing
must be.
finance.
Hold on. Assuming you go to the exam so then ICA gives you some questions, some theory. It says A. Business valuation is a technique that is used to determine the market price of a company's shares. Various companies have used business valuation as a strategy when embarking on various, projects or whatever. Then they tell you required. They ask you to provide 5 reasons that will necessitate business valuation to be performed. They are asking you to give 5 reasons. These are the 5 things you put down and get the marks. So talk to us. Yes.
Sir, for securing loan.
For securing loan. So we are saying that 5, when shares are pledged as collateral, when shares are pledged as collateral, when you want to take a loan, you can pledge your shares as collateral, that the company can take over some shares. If you don't pay, you are unable to pay. When shares are pledged as collateral in securing what? Are you getting it?
Yes, sir.
Is there any other reason? At least 5 is okay. I believe you are taking notes.
Sir, we are taking notes.
I believe you are taking notes. Me, I've written my paper already. You are going to write. Therefore, if you decide not to bother certain things, it is up to you. Why the evaluation? Madam taking screenshots. You can give us some nice
please,
screenshots.
the point 4.
When there is a scheme of measure and participating companies' shares.
And acquisition.
When there is a scheme of measure and participating companies' shares must be valued. Are you getting it?
Yes, sir.
Good. Madam, who is taking the screenshot? Are you dealing with it for us?
Yeah.
Okay. Like when I finish, I'll give you the board so that you take it. It seems somebody wants to give us a nice answer. Let's look at the person. Who is that? Rena's iPhone. During legal disputes and the retirement of a director. You see, somebody is saying that when there is legal disputes and then a director is retiring, they have to value the shares. Are you getting it? You see the nice reasons people are giving. In exams, or ICA cannot ask you for more than 5 reasons. So interesting, yes. In situations of legal disputes, you said legal disputes and what? A director is resigning, right? Right? Now, Rena, let's hear from you. You gave the answer. So clarify for her. You said the legal dispute when what? Rena.
He said, and the retirement of a director.
And what?
The retirement. When a director is retiring.
In situations of legal disputes resulting in retirement of a director. Okay, that's fine. Okay, so this is okay. Now, what you need to know is the methods. We use methods of determining market prices of shares. You see, at ICA level, there are a lot of methods. But then at ICA level, some people are also giving us something. Someone said, well, during this, when shares of unlisted company are to be sold, yeah, that's it, attracting investors and financing, that is it. Talk about that. Yes, methods of determining company share prices. Let's go straight. At ICA level, they'll be interested in this. They'll be interested in the default method. The default method is what we call the net assets method. This is the obvious method, number 1. That is default, meaning that at least if you don't have any method at all, you can use that. The net assets method. Then we have what we call dividend yield approach. Dividend yield approach. We have dividend yield approach. We have earnings yield approach. Earnings yield approach. Dividend yield approach, DY. Earnings yield, EY approach. Then we have what we call price earnings ratio method. Price earnings ratio. Price earnings ratio method. That's PE ratio. That's PE ratio. Then we have the discounted cash flow technique. Discounted cash flow method. Then we have the dividend growth model. Dividend growth model. We have this, in fact, in ICA level, this is, well, you can also use capital asset pricing model, but normally capital asset pricing model, they are examined under financial management, and then maybe it will reflect in strategic case study, the financial strategy. But for ICA level, in fact, these six methods, no matter the question they give you, you may be asked any of these six methods. So you need to understand how to calculate these six methods very well. So I'll explain the methods to you, and then at 6:30 we close. It means that in our next meeting on business valuation doesn't take time to solve. So we can solve even three questions and finish with business valuation. Then we begin with capital reduction scheme.
Okay.
Business valuation, we'll finish capital reduction scheme. Then now we come and look at interpretation. Interpretation, I'll teach you the key strategies in interpreting the normal financial statement. We'll look at how to interpret the statement of cash flows. When there is an acquisition of a subsidiary and those things, we'll look at how to interpret them very well. So my dream is that should you go to the exams for at least the theoretical areas, sustainability, ethics, and then you look for some 5 marks. 5 is okay. Just look for some 5 marks there. Go and make about some 15 in Conso. That will be about 20. Go and make about some 10 in business valuation. That will be about 30. Go and make another 10 in interpretation. That will be about 40. So the whole standard, that 30 marks, we are just looking for some best 10 to pass. There's no way the paper should frustrate you at all, having gone through this rush hour thing of it. Can we move on?
Yes, sir. Yes, sir.
Okay, so let me go up. Now, so the methods. The first one, which is the net assets method, that net assets method. Now, in reporting, when we say net assets, it's assets less liabilities. Exactly, that's equity. Are you getting it? We are determining equity. Asset less liabilities. But remember that all the business valuation we are doing, we are valuing the ordinary shares. So we are performing it with regards to the ordinary shareholders. Exactly. So if there is any issue relating to preference shares, you take them out. Are you getting the point?
Yes, sir.
Hello?
We are here.
Yes, sir, we get it.
Saying that the business valuation we are doing, we are valuing the ordinary shares. So we are doing it in relation to the ordinary shareholders. Therefore, anything that has to do with preference shares, you take it out. So in the net assets method, you first list all the assets you have there, all the assets at their market value. So let's say, yes, the assets, what are the assets? Give me some of the assets. Land and building. You mentioned some of the assets for me. Land and building, put the value down. Plant and equipment. The question will give you the fair values. Put them down. Equipment. Then let's say motor vehicles. Motor vehicles. Yes, these are the non-current ones. And then the current ones will be what? Inventory. Inventory. Receivables. Cash and banking. Just list all your assets. So assuming these are my fair value of assets, When I add this will give me the total assets, right? Right?
Yes.
This is the
Yes,
total
sir.
asset. Then you come to the liabilities. Yes, the liabilities. Let's assume we have a debenture, non-current liability. Let's assume we have a debenture. Then let's assume we have what? Payables. Payables. Let's assume these are the liabilities we have there. Sum all of them and then take them out. Take them out
Sir,
like
please,
this. Yes. Yes. Who is speaking?
please, I wanted
Take
to ask
them
a
out.
question.
So go ahead. I'm listening to you.
Please, I want to ask, as part of the asset, in case we have goodwill as part, would you add it?
The question may tell you that, I mean, it should be written off, or the question will not be ambiguous. Is that clear?
Okay.
Yes. So you take this out. Now, when you take this out and then you get the result, if there is any preference shares, like I told you, we are doing this in relation to ordinary shares. So if there is any preference shares, you need to take it out. So you need to show all of them one after the other. So you've taken total assets minus total liabilities, then you take the preference shares out. Preference shares, you take it out. So when you take it out, you get this. Assuming this is XA, then it means that the market price per share will be the XA, which is the net assets, over the number of what? Ordinary shares, what you call equity shares. Is that clear?
Yes, sir.
Over the number of equity shares. This is what you do. I believe you are writing something down.
We are.
You sum all the assets, take out the liabilities, then the result, if there is any preference shares, net it off. Then whatever you get, you divide by the number of equity shares. That will give you the net assets method. Very, very, very easy and straightforward. In fact, all students I teach, I tell them that if you are in my class and I teach you business valuation and you meet a question and you spend 20 minutes on it, then it means that you yourself want to fail. You are inviting the spirit of failure into your life. By inviting the spirit of failure into your life. If I teach you business valuation, you should not spend more than 20 minutes on business valuation. And so my target for my students are that once I teach you Conso, I teach you business valuation, I teach you capital reduction scheme and this. When you go to the exam, so your Conso 35 minutes, interpretation 35 minutes, that's 70 minutes. Business valuation or capital reduction 20 minutes, that's 90. So within 1.5 hours, you've killed the three, you've killed Conso, you've killed business valuation or capital reduction scheme, and then you've killed interpretation. If you get about 15 from Conso, 10 from interpretation, that's 25. Business valuation and capital reduction, 10, you have 35. So within 1.5 hours, you have 35 marks already. Then now you relax. Within 1.5 hours, you have 35 marks. Then now you relax and let the tension go. And you start tackling the theoretical areas small, and then the standards. The standards, everybody knows that we will teach you the standards and you understand them. But when you go, you forget. It's not because you don't know. It's because the standards are just too many for your absorption. So the ones that you absorb and you remember, when you take the question, you attempt it, take some 2 marks. You take an hour, take some 2 marks, get 10. Get 10 to 12 over 30, you are okay. You are not there to get 100%. Then let ICA take their troubles away. Okay, so that's the net assets method. Now, let's also look at what we call the dividend yield method. Dividend yield method. DY. Now, look at what I do. Now, this is what I do. That's what this. Nobody should chew anything. In ratios, when you hear the word yield, if you hear the word yield, it means over price per share, over market price per share. If you hear the word yield, it means over market price per share. So if you hear dividend yield, dividend yield, it means dividend. I said yield means what? Yield means what?
Over
Market price per
price
share.
per share.
Price per share.
Market
When
price,
you get
market price per
dividend
share.
yield, it means dividend over price per share.
Market
Can you
price
see?
per share.
It's the market price per share we are doing. So don't waste time writing market. Let's move. So dividend yield, DY, is equal to dividend over price per share. But in accounting or in mathematical numerical analysis, anytime you are comparing two things, they must have the same basis. Is that clear?
Yeah.
Yes.
So once this is price per share, the dividends should also be per share, meaning dividends per share over price per share. Is that clear?
Yes.
Now, those of you who have been chewing, please listen to me. I know that for business valuation, the sickness of students is that they have been chewing, adjust upwards, adjust downwards, adjust corner, adjust left, right, center, front, and that kind of thing. I beg you, I am not asking you to chew anything. I'm not asking you to chew anything here. Listen to what I'm saying and get it right. You are looking for the price, the whole business valuation you are doing. What are you doing? You are looking for the price per share, right?
Yes.
So if you are looking for the price per share and you have an equation like this, just do change of subject to get the price per share. So to do my change of subject, it means dividend yield DY times the price per share will be equal to my dividend per share. Do you agree?
Yes.
Yes.
Just behave as if you are a class 1, a class 3 student doing change of subject. Dividend yield times price per share equals dividend per share. But I'm looking for the price per share. So if I do my change of subject, it will become price per share will be equal to what? Dividend per share. Then DY will go there to do what? Divide over dividend yield. Are you getting it?
Yes, sir.
So this is the target formula you will be using. So you see, in the exam, Enoch, I will not chew anything. Once I know I can do my simple change of subject, I'll rather do the change of subject and get the correct formula. Because if you chew and you make mistake in writing the formula, everything will be wrong. So instead of chewing, I'll write the main formula down that if it's dividend yield I'm solving, dividend yield is equal to dividend per share over price per share. Then I do my change of subject to bring out the price per share. Now, what you need to know is that a company who is listed on the stock exchange is less riskier than a company who is not listed on the stock exchange. Is that right?
Yes, sir.
Therefore, the one who is listed on the stock exchange must have a better price than the one who is not listed. Are you getting the point?
Yes.
Good. So if you want the one who is not listed now, we are now going to list him. It means his price must be smaller. Is that right?
Yes.
The one we are just about to list, he must have a smaller price. So for him to have a smaller price, let's do a bit of mathematics, what we did in primary school. Assuming I had 10 divided by 2, the answer will be equal to what? 5, right?
Hi.
Yeah.
Now, if I want this answer to be small, I want the 5 to be small. If I want the 5 to be smaller, if I want the 5 to be smaller, the denominator 2, must I increase it or I'll reduce it?
Increase.
To increase it.
Yes, so if I want the 5 to be small, it means I need to what? I need to what? Increase the denominator. Are you getting it?
Yeah.
Do you agree I must increase the denominator?
Yes.
So to increase the denominator, when I increase the denominator to, let's say, 4, you will see that the 5 will reduce to 2.5. Are you getting the point?
Yes.
What it means is that the unlisted company, you want its price to be small. Therefore, if you want its price to be small and dividend yield is the denominator, then you must increase the denominator. Do you get the point?
Yes.
Okay.
So the increasing of the denominator means you adjust it upwards. Do you now see why they tell you adjust upwards and adjust downwards?
Yes.
Do you now understand?
Yes, sir.
So it's not a game whereby you have to chew in your head that, oh, some people have chewed in their head that, okay, for dividend yield, I'll go up. For earnings yield, I'll come down. For PE ratio, I'll go up. And they keep on confusing themselves. So where they are supposed to go up, then they come down. Where they are supposed to go down, then they rather go up. In the exam, so under intense pressure, when the questions are tough, if you are not careful, even the one that is easy for you to solve, Because you have chewed something in your head, you will be confused and put down wrong facts. Do not chew that you need to adjust upwards or adjust down. The reason why we adjust upwards or we adjust downwards is that you have a fraction, and you want the denominator, you want the answer to be small, the price per share, which is the final answer, you want it to be small. So for the final answer to be small, the denominator, you do what? Are you getting the point? Do we understand?
Yes, sir.
Okay,
So we
sir.
are saying,
Please,
yes,
so the adjusting upwards is the increasing the denominator, right?
exactly. So you are increasing the denominator, the dy. So what I'm saying is that now I need a smaller price per share. This is what I'm saying. I need a smaller price per share for the unlisted company. So if I need my answer to be small, it means hence I must increase the denominator. Do you understand it now, madam?
Yes,
The
please.
one
Yes,
the question
thank you.
hence I must increase the denominator. And the denominator in this case is the dy, the dividend yield. Are you getting it?
Yes, sir.
So it means that I'll take the dividend yield of a listed company. They will give you the dividend yield of a certain listed company. I'll take it. Then because I'm increasing it, I'll adjust it upwards and you adjust it upwards. Remember, we are
Good
increasing
morning. Okay.
upwards to increase it. You adjust it upwards by what we call the risk factor. The question will give you a risk factor. If it doesn't give you, assume 20%. It's okay. Adjust upwards by a risk factor. Where the risk factor is not given, if they give you, you have to use it. But where a risk factor is not given, yes, assume 20%. It is correct. You assume that it is 20% more riskier to invest in unlisted companies than to invest in a listed company. Are we getting the clue?
Yes, sir.
Yes, sir.
I believe after today, nobody will chew, adjust upwards, adjust downwards, adjust corner left and right. I believe after today, nobody will chew.
Sir, won't you it?
We don't learn by chewing. We learn by understanding. Understand the fact and go and present it. Now, if you understand this, then I can say that if I should go to the next method, please, have you taken them?
With the screenshot, sir.
Okay, so let me finish up so that you take screenshot. Now, let me go to the next method and then finish it up so that
It's okay.
assuming
It's
Please, those talking behind. Beg you.
wonder we are mature students. You should what this. Now, earnings yield approach. Earnings yield approach. That is EY. Using the same thing I taught you. What do? You first write your formula for earnings yield. I told you that a yield means over price per share. So when we hear the word earnings yield, EY, it means earnings. So earnings over yield means what? Price per share, right?
Yes.
Earnings over price per share. And I've told you that anytime you are comparing two things, they must have the same basis. Therefore, if the denominator is price per share, the numerator must also be what? Per share, right? That means earnings per share over what? Price per share. Are you getting the point?
Yes, sir.
Yes, sir.
Then at this point, what do you do? At this point, what did I ask you to do? If you write,
You do change of subject.
Do the change of subject.
good. Very good. So the reason why you have been failing the business valuation is that you don't do your change of subject. You rather chew the final formula, and the formulas look alike. So every day you are writing wrong formula in the exam. So every day you are writing wrong formula. Instead of chewing, maintain the original formula and do your change of subject. So to do my
Okay.
change of subject, it means earnings yield, EY, earnings yield times price per share will be equal to earnings per share. Do you agree?
Yes, sir.
Therefore, if I'm looking for price per share, you know what to do. If you give this to a class 3 student, it will do it very, very, very simple. So it means that price per share will now be equal to what? Earnings per
EPS
share
over
of
EY.
earnings yield. Then this is your target formula. I can box it. So in the exam, so I'll box this nicely so that anytime I'm going, I'm referring to it that this is what I'm using as my target formula. So based on my target formula, I will calculate my EPS. If I calculate my EPS to get the earnings yield, yes, I'm dealing with an unlisted company. I want its price to be small. So what will I do to the earnings yield? It's a denominator. So what will I do to it?
You increase.
I increase.
So you see that now you know you increase it. Then you will say
Yes.
that yes, to make the price per share of the unlisted company, to make the price per share of the unlisted company smaller, what must I do? You need to what? Increase the denominator. So we need to increase the denominator, which is what? EY, earnings yield. Therefore, what do? I'll take the earnings yield. I'll take the earnings yield of a listed company, a competitor listed company. Then once I take that, because I'm supposed to increase it, what will I do? And then I'll adjust it. Are you getting it?
Mm.
So I'll adjust it what? Upward, right?
Yes, sir.
I'll adjust upwards by what? The risk factor. I've already told you the risk factor. If they don't give it to you, take 20. If they give it to you, fine. By the risk factor. That's the game. So you see, the reason why you are being told to adjust upwards and adjust down, it's not just adjusting. You must rather understand that the reason why we are adjusting it upwards is that the thing is a denominator and we want the final answer to be small. So the only way the final answer can be small is to increase it. Are you getting the point?
Yes,
Yeah.
sir.
Good. So when you understand the real reason, then you'll be able to solve and make meaningful impact. That is earnings yield. Now let me look at PE ratio method. Let me look at PE ratio. PE ratio. PE ratio approach. Quickly, I'll write my formula. Price earnings ratio. Even the formula, the name alone will tell you what the formula is. Price earning ratio. It means price over what? Earnings, right?
Amen.
Right?
Yes.
Sir.
Price earning. It means price over earnings. So I'm going to say, so PE ratio will be equal to what? The price over what? Earnings. And I told you that we are calculating it in per share basis. So price per share over what? Earnings per share, right?
Yes.
Yes.
Now, what am I looking for here? What am I looking for here?
You are looking for the price per share.
So
So
let's do our
change
change of
of
subject.
subject.
What will our change of subject be? It will be PE ratio times what?
The
EPS
Times
is
EPS.
equal to what? Price per share. Do you agree?
yes, sir.
Do you all agree?
Sir, I agree.
So this is my formula for the price per share. Then I box it nicely. This is my target formula. Therefore, the EPS, I can calculate it very easy. Now, the PE ratio, now it is multiplying. So we are rather doing the reverse. Let's look at the scenario here. The scenario I did with the 10 and 2. Now it's a multiplication. So the point is that what? If I have 10 times 5, and then it is what? 50. Do you get it? If I want the 50 to be smaller, if I want the answer to be smaller, must I increase the 5 or I should reduce it?
You should reduce it.
And I want it's now a multiplication. Since it's a multiplication and I want the answer to be smaller, must I reduce the 5 or increase it?
Say reduce it.
Reduce.
So when I reduce the 5, when I reduce the 5 to, let's say, 2, then we see that 10 times 2 will now be what? 20. It has reduced. Are you getting it?
Yes.
It means it means that for a smaller price per share, for a smaller price per share of the unlisted, we want to get a smaller price per share of the unlisted company. What will you do? Yes, yes, the P ratio. You said we should reduce it, so we adjust it. You adjust it what? So we'll decrease the PE ratio. So to decrease the PE ratio, what will we do? We'll take the PE ratio of a listed company, right? So we take
Yes,
PE
sir.
ratio of a listed company. Now we are reducing. So what must we do? We adjust it what? Downwards, right?
Mm-hmm.
And then you do what? You adjust what? Downwards. You adjust downwards. That means you decrease it. If you adjust downwards, you decrease it by, yes, you adjust it downwards by what? The risk factor. We have already talked about risk factors. So by the risk factor. This is what you do. So you see, we talk about net assets method, dividend yield method, earnings yield method, PE ratio. We've talked about it. Are we getting the understanding?
Yes.
Yes, we are.
Then the last one, discounted cash flow. Let me talk about discounted cash flow. Let me talk about discounted cash flow, then we close. Discounted cash flow. This is the easiest of all. Discounted cash flow simply means that you are discounting all the cash flow. So you discount all the future cash flows. Please, it is the future cash flows you are discounting, not just any cash flow at all. Discount all the future cash flows from the business. From the business, you discount all of them to what? Present value. Is that clear?
Yes, sir.
You discount all to present value. So you can take the year, take the cash flow, multiply by the discount factor. If the cost factor is 10%, then take the present value. So year one, take the cash flow, multiply by the discount factor, get the present value. Year two, take the cash flow, multiply by the discount factor, get the present value. They'll give you forecasted cash flow for about 5 years. So take year three, cash flow, discount it, get the present value. Year four, take the cash flow, discount it, get a present value. Then year five, about 5 years, it's okay. Cash flow, discount it, get a present value. Then sum all and get this. Now, when you get this, then the price per share will be the XA you have gotten over the number of ordinary shares. Is that clear?
Yes, sir.
This XA you have gotten over the number of ordinary shares. This is what you do in the cash flow. I think discounted cash flow there, you all know it already. It's very simple. Now, what you need to know about the cash flow is this. In our next meeting, when we are solving questions, I don't want anybody to make noise here. Watch. The relationship between cash flow and profit. Relationship between cash flow and profit. Now, in accounting, to get profit is obtained by taking all the cash flows minus non-cash elements. In this case, the non-cash element is depreciation. So if profit is equal to cash flow minus what? Depreciation. Then if they've given me profit and I need the cash flow, what will I do? It means profit, I'll add back depreciation. Is that clear?
Mm-hmm.
So profit plus depreciation will give me the cash flow. Are you getting the point?
Yes, sir.
Profit is cash flow minus depreciation. And here it is the cash flows that we are discounting, not the profit. Therefore, if they're giving me the profit, if they're giving me the cash flows, I need to take depreciation out to give me profit. If they're giving me, if they're giving me profit, I need to add depreciation to get cash flow because it is the cash flows we are discounting. Now, you should also note this. You should note this. The examiner can put this same thing in theory. If it tells you profit before depreciation, if it tells you profit before depreciation, it means that profit before they take care of what? Depreciation. So any profit before depreciation is it a cash flow or a profit? Mhm. Yes,
Cash flow.
profit before they take care of depreciation. Is it a cash flow or a profit?
Cash flow.
Cash flow.
That is cash flow. Are you getting it? Then a profit after depreciation, a profit after depreciation, a profit after depreciation is a real profit. Are you getting the point? So if the examiner wants to trick you, he can tell you that the profits above are before depreciation. Once he tells you it is a profit before depreciation, it means they are actually cash flows. Are you getting the point?
Yes, sir.
So you don't need to subtract again. You go and discount because it is the cash flows we need to discount. So once the question tells you that these profits are before depreciation, it means they are actually cash flows. So you don't do anything to it again. You go and discount straightforward. But if it tells you that the profits are after depreciation, a profit after depreciation is a real profit. And remember, it is not the profit we are discounting, but we are discounting cash flow. It means you have to convert that profit to a cash flow by using this formula that to get cash flow is profit plus depreciation. Are we understanding it?
Yes.
Do we all understand?
Yes.
Yes.
Yes, sir.
So if you understand this, it's 6:30 exactly. We will wrap up here. I expect you to sit down and master your cash flow. The two cash flows you've done, sit down and master it. Once you have mastered it, business valuation, learn the methods again and again. Have I asked you to chew anything in my class?
No, please.
Did I ask anybody to
No.
chew anything?
No, sir.
I explained to you to understand and go to the exam so write the main formula and do your change of subject. Therefore, if you don't want to do the change of subject and you go and chew and you are chewing adjust up, adjust downwards, and you go and make a mistake, that one it will be your own cup of tea. I have spent time to explain clearly to you that we do not chew to write exams. We understand to write exams. I think everything I've explained here is very clear to your understanding, right?
Yes.
Yes, sir.
Good. If you understand, then I'll come up for Madam to take screenshots for us. So, Madam, first of all, take screenshot of this part for us. Somebody wants to ask a question. Let me see. That's fine. Yes. Who is taking the screenshots?
Sir, please, I have. Sorry, I was mute.
Are you taking this one?
Yes, sir.
So I should go up to number 5, right?
Mm.
So here, let me put it here. Take this one. Are you okay?
Yes, sir.
Then let me go up a bit, up to the liabilities part 2. Let me go up to the liabilities part. Take this one. Are you okay?
Yes, sir.
Then let me go up to this portion. Take this one.
I have.
Are you okay?
Yes, sir.
Then let me go up to this side. Take this one.
I have.
And let me go up. Who is taking the screenshot for us? Yes. Take this one.
I have.
So this is the end. Now, who has taken the screenshot? Who is the one taking the screenshot?
Sir Angela.
So please, we'll be expecting to see Angela give us screenshots on the page. Those who have been taking the screenshot, what they do is that when they take it, they will have to go and sit down. Then they learn it till they are satisfied before they put it on the page. We don't do that. Once you take the screenshots, when we are done, share it on the page for us so that we will all get, we will all get it to learn. Don't go and learn and satisfy yourself before you come and give it to us.
So please, I've already done the first one.
Okay.
And
Can you scroll down small?
To which side? Which side?
Yeah, so up, please.
Here?
Again.
Here?
Yes.
Let me reduce. Let me zoom
Yeah,
in.
reduce the size.
This one.
Okay.
This one.
Yeah, sir, please scroll down. No, upward, sorry.
Up to where? Yeah.
Sir, please go.
I should continue going.
Yeah.
Up to where?
Yeah, here is fine.
Like this?
Yeah, it's okay.
Okay. Are you fine?
Yes, sir.
Okay. Colleagues, I believe we've had a good day.
Yes, thank you so much.
Is everything clear?
God bless you, sir.
Yes,
So
Sir,
you
please,
have,
when are you uploading it?
they will do it by the close of the day or possibly tomorrow morning.
Okay.
Now, please, I think we've had a good day. When again are we meeting for corporate reports? I think Monday, right?
yes, sir.
Now, so you have between today and tomorrow to do your revisions very well. On Monday, we are using the full period to solve. So we are going to solve questions. So the two questions I've given to you, November 2020 and November 2021, I will look for one powerful one and add it to it. In fact, those two questions alone is enough to tackle it. So I'll look for one more powerful question, the one that has dividend growth model, so that you will see that one too. Those three questions will address your business valuation. And so on Monday, we will solve three questions. Today, I'll release the one for you. I've already given you two, November 2020 and 2021. I'll release one for you. When I release the one for you, on Monday, we'll solve. I believe when we solve those three, our issues on business valuation will be a thing of the past, right?
Yes, sir.
Yes, sir.
Once we have done that, we will move to capital reduction. So capital reduction, by the weekend, 2 meetings will be enough. By the weekend, we will clamp down capital reduction and finish it so that next week, we will go to interpretation. When we have used the week to kill interpretation, then now we come and take the standards. So as many standards as you wish, the standards that I know that causes problems for you, like I've said, the tough ones, we have standards like this. These are the standards I'll be looking at. I won't look at something like PPA and those kind of child play. No. We'll look at something and asset standards, maybe IAS 36 impairment. IAS 36 impairment, maybe IAS 23 borrowing cost to some extent. Then the liability standards, I'm going to look at IAS 37 provisions. I'm going to look at IAS 12 income tax. I'm going to look at IFRS 9 financial instruments. Financial instrument is governed by 4 standards: IAS 32, IAS 39, IFRS 7, IFRS 9. One standard, standard, and it's a combination of 4 standards combined. It should tell you that financial instrument is a key standard. No matter what you do, you meet it somewhere in the paper. Financial instrument, we'll deal with it. Then IAS 19, employee benefits, we'll do it. Then IFRS 2, share-based payments, we'll deal with this standard. I'm sure if we have tackled this and then we do IAS 33, earnings per share, trust me, this group of standards, if I tackle this very well with you and strengthen it with you, if you are not fortunate at all, at least 2 of them should appear in the exam. There's no way they can set the exams without any of these standards. They'll have 2 asset standards and liability standards. No matter what, in the liability standard, 1 or 2 of these will feature. So let's strengthen it well. Now, let's be real to ourselves. We are going to write an exams that is very, very challenging. You cannot all aspects of the course very easy. Are you getting the point?
Yes.
You cannot get all aspects of the course very easy. But at least, if you are fortunate that you have an easy area like sustainability and ethics, nice theory, sustainability and ethics, I'll tell you what to do there. I mean, if you have a nice theory like this, which you can fight for some 8 marks from, and then you've strengthened your Conso very well, you've strengthened your business valuation very well, you've strengthened your interpretation very well. Now, something like Conso, make sure that out of that 25 marks, if you can't make at all, make 15. You do the calculation well. If you cannot even answer the theory, you make 15. Something like interpretation, that 15 marks, you make 10. Leave there 5 for them. Something like business valuation and capital reduction scheme, make about 12. Make about 12 and leave the rest for them. So you will see clearly that, look, this alone will give you about 45 marks. So when you go to the exam, so this is the strategy you should be adopting. I decided to tell you this today since we are going to. When you go to the exams or to write the exams, don't just be answering the question. Now, if they give you the 15 minutes planning time, in the 15 minutes planning time, you don't use the 15 minutes planning time to be solving questions. What you will do is that in that 15 minutes planning time, you find the theory answers, write down your theory answers, locate the theories and jot down the answers on the question paper. So your theories, locate the theories and jot down the answers on your question paper. And then look for your two best calculations, check through. And always, from experience, your two best calculations will come from this: Conso, interpretation, business valuation, and capital reduction scheme. These three, that is where the students get most of their marks. So look through that out of these three, what is your two best bets? So the moment they ask you to start work, make sure that the first 20 minutes, you go and do your theories, sustainability, ethics, and the rest. You go and do your theories. Out of that 15, don't worry yourself. You just take about some 8 marks. You don't look for so much. You are not in the exam, so to get, if you are targeting an award, more grease to your elbows. But if you know that it is not an award you are looking for, you just want to escape the troubles of ICA, I beg you, don't worry. You look for 8 marks. Just look for 8 marks, that theory. Then now, 35, your Conso, 35 minutes. Do your two best calculations. So your two best calculations, if it is Conso or interpretation, if it is Conso, you are 15. If it is interpretation, you are targeting 12. So do this. If it is business valuation, you are targeting 12. If it is business valuation, you are targeting 12. If it is interpretation, you are targeting 10. So it means that here, your total you are going to get here is going to be either 15 and 10 or 15 and 12. So at least you will make 25, either 25 or 27. Get this. Then when you are done, the next, so this will give you 90 minutes. By 1.5 hours. What it means is that by 1.5 hours, you would have made 25 plus 8, which is about what? 33. If by 1.5 hours, you've made 33. Now you need 1.5 hours more. Exercise patience, and then the next 1 hour, you go and tackle your standards. When you go and tackle your standards, and then you make some 10 marks over there. When you go and tackle your standards, and then you make 10 marks over there. Go and make 10 marks over there. When you make about 10 marks over there, that is about 43. Then the last 30 minutes, I go over your work and make top up. If you can get something from the theory, go and make top up. Get some 5 more or some 2 more. Go to your Conso theories and then you top up your work. So the 50 plus, no matter what you do, you can. So please, what you need to do is that go and train yourself. Whose background is that? Whose background is that? Whose background is that?
Are only the owners of the share. That's why if you look at company law anywhere in the world.
Whose background is that? Who is doing that? Yes. So make sure that you go and then practice your Conso to the extent that you must not spend more than 35 minutes. So the Conso that I've solved with you and you are practicing, solve them over and over and over and over to make sure that when you get the question, you don't spend more than 35 minutes. That's why you are targeting 15 to 18 marks to pass. So don't take chances. I think somebody raised their hand. Who raised their hand? Don't take chances, please. Don't take any chances. Go and practice and make sure that maximum time you can spend for a calculation is 35 minutes. When you do that, you are good to go. I believe as we forge ahead, your understanding is improving. From the beginning of rush hour till now, are you improving in your understanding?
Yes.
Yes.
If you are not improving, then there is no need joining again, because you cannot sacrifice your sleep and you don't also understand. Then what are you doing? Is your understanding
We are
improving?
improving.
Okay, if you are improving, then thank God. It's been a nice day. We'll end here. We'll meet again on Monday. Till then, may the good Lord be with us all.
Amen.
Amen.
Amen.